For many, the dream of homeownership is synonymous with financial security, a place to build a life, a legacy. Yet, for countless individuals and families, this dream quickly transforms into a daunting maze of complex terms, hidden fees, and overwhelming decisions. Consider the story of the Smiths, a young couple, ambitious and ready to buy their first home. They found a house they loved, secured what they thought was a great rate, only to realize years later, they'd overlooked critical details that would cost them dearly. Their experience is not unique, it's a testament to the pervasive lack of foundational knowledge surrounding mortgages. A mortgage isn't just another loan. For most people, it represents the single largest financial commitment they will ever make. It's a contract spanning decades, often involving hundreds of thousands, if not millions, of dollars. Financial analysts widely agree that a poorly understood mortgage can be a direct path to financial distress, eroding savings, and limiting future opportunities. Conversely, a well-structured and understood mortgage can be a powerful wealth-building tool. The distinction lies in knowledge, in navigating the system with a clear understanding of its underlying principles. This investigation probes the mortgage landscape, dissecting common misconceptions and revealing surprising truths. We aim to empower you, the viewer, with the aha moments that transform uncertainty into confidence. We'll present 10 golden rules, forged from the analysis of countless financial journeys and expert consensus, to guide you through this critical process. Our goal is not just to inform but to arm you with the strategic insights necessary to secure not just a house, but a sound financial future. Each rule is a cornerstone, designed to prevent the costly mistakes made by many. At its core, a mortgage is a loan specifically used to purchase real estate. Unlike an unsecured personal loan, a mortgage is secured by the very property it finances. This means the house itself acts as collateral. If the borrower defaults on payments, the lender has the legal right to take possession of the property, a process known as foreclosure. This fundamental principle dictates much of the mortgage industry's structure and the lender's due diligence. Understanding this security aspect is crucial for appreciating why lenders have specific requirements and conditions. Most people focus intently on the advertised monthly payment. But what does that figure truly represent? Primarily, it's a combination of principal and interest. The principal is the amount you borrowed, while the interest is the cost of borrowing that money. Early in a mortgage term, a larger portion of your payment goes towards interest. Over time, as the loan amortizes, more of your payment begins to reduce the principal balance. This amortization schedule is a critical, yet often overlooked, detail that dictates how your equity builds over decades. Our first golden rule is unequivocal: your credit score is king. This three-digit number, often shrouded in mystery, is arguably the most powerful lever in securing favorable mortgage terms. Lenders use it as a primary indicator of your creditworthiness, your perceived ability and willingness to repay debt. A higher score signals lower risk to lenders, directly translating into lower interest rates. Conversely, a low score means higher risk, resulting in significantly higher rates and potentially even loan denial. This isn't just about getting approved, it's about saving tens of thousands of dollars over the life of your loan. To illustrate the profound impact of your credit score, consider this. Data from industry analysts suggests that a borrower with an excellent credit score, say 760+, could qualify for an interest rate half a percentage point lower than someone with a good score of 680 to 700 on a 30-year fixed mortgage. On a $300,000 loan, that seemingly small difference could mean paying over $50,000 less in interest over the life of the loan. This isn't a theoretical figure, it's tangible savings directly influenced by a number you can control and improve. Building a strong credit score isn't instantaneous but follows predictable patterns. Payment history accounts for roughly 35% of your score, making on-time payments paramount. Credit utilization, the amount of credit you use versus your total available, contributes about 30%, keeping this below 30% is often advised. length of credit history, new credit, and credit mix also play roles. It's a holistic view of your financial discipline. Therefore, before even looking at houses, look at your credit report, identify errors, and strategize improvements. Our second golden rule: always understand your true affordability, beyond the headline monthly payment. Many prospective homeowners fixate solely on the principal and interest portion, forgetting the petty components: principal, interest, taxes, and insurance. Property taxes and homeowners insurance can add hundreds, sometimes thousands, of dollars to your monthly outlay. Furthermore, factors like HOA fees, potential repair costs, and increased utility bills in a larger home can dramatically impact your actual living expenses. Underestimating these can quickly turn a dream home into a financial burden. Lenders use a critical metric called the debt-to-income (DTI) ratio to assess your repayment capacity. This ratio compares your total monthly debt payments to your gross monthly income. Most lenders prefer a DTI ratio of 36% or less, though some programs may allow up to 43 to 50%. It's a key indicator of whether you can comfortably manage additional mortgage payments. If your DTI is too high, even with a good credit score, you might be denied or offered less favorable terms. This ratio serves as a vital checkpoint, not just for lenders, but for your own financial prudence. Our third golden rule addresses one of the biggest initial hurdles: the down payment dilemma. Common wisdom often dictates a 20% down payment is essential. While a 20% down payment offers significant advantages, it's a surprising truth that it's often not mandatory. Many loan programs, particularly for first-time homebuyers, allow for down payments as low as 3.5% or even 0% for qualified veterans. However, a smaller down payment typically means a larger loan, higher monthly payments, and often, the requirement for private mortgage insurance, or PMI. This is a critical trade-off to understand. When your down payment is less than 20% of the home's purchase price, lenders typically require private mortgage insurance. PMI protects the lender, not you, in case you default on your loan. It's an additional monthly cost, often ranging from 0.3% to 1.5% of the original loan amount annually, divided into your monthly payments. For example, on a $250,000 loan, 1% PMI adds $208 per month. While PMI allows you to buy a home sooner, it's a direct expense that doesn't build equity. Understanding how and when to remove PMI is a key financial strategy that many borrowers overlook. Our fourth golden rule is deceptively simple but incredibly powerful: always shop around for lenders. Many borrowers, particularly first-timers, make the mistake of going with the first lender they speak to, or simply accepting the offer from their existing bank. This can be a costly oversight. Mortgage rates and fees can vary significantly between different lenders, sometimes by as much as half a percentage point or more. Over a 30-year loan, even a quarter-point difference can amount to tens of thousands of dollars in extra interest paid. Lenders compete for your business, and you should leverage that competition. When comparing loan offers, look beyond just the interest rate. Focus on the annual percentage rate, or APR, which includes not only the interest rate but also most of the fees and other charges you'll pay. This provides a more accurate picture of the total cost of the loan. Also, compare closing costs, lender fees, and ensure you receive a loan estimate from each lender. The Consumer Financial Protection Bureau mandates these standardized forms, making apples-to-apples comparisons much easier. Failing to compare multiple offers is akin to buying a car without test driving any others. Our fifth golden rule delves into a fundamental choice: fixed-rate versus adjustable-rate mortgages, or ARMs. A fixed-rate mortgage ensures your interest rate remains the same for the entire life of the loan, providing predictable monthly payments and stability. An ARM, however, typically starts with a lower, fixed interest rate for an initial period, e.g., 3, 5, 7, or 10 years, after which it adjusts periodically based on a specified index and margin. The choice hinges entirely on your financial outlook, risk tolerance, and how long you plan to stay in the home. This isn't a one-size-fits-all decision. ARMs can be attractive due to their lower initial interest rates, which means smaller payments for the introductory period. This can be advantageous if you plan to sell or refinance before the fixed period ends. However, the risk lies in the unknown. When the rate adjusts, your monthly payment could increase significantly, especially in a rising interest rate environment. This could strain your budget unexpectedly. Financial experts caution against ARMs for borrowers seeking long-term stability or those who might struggle with higher payments in the future. Evaluate your exit strategy and market predictions carefully. Our sixth golden rule demands a thorough understanding of closing costs. These are the expenses, beyond the purchase price of the property, that buyers and sellers pay at the closing of a real estate transaction. Often ranging from 2% to 5% of the loan amount, these costs include various fees like loan origination fees, appraisal fees, title insurance, recording fees, and attorney fees. For a $300,000 home, this could mean an additional $6,000 to $15,000 due at closing, a sum that frequently catches first-time buyers off guard. These aren't optional, they are a necessary part of the transaction. While many closing costs are non-negotiable, there are some areas where you might find flexibility. For instance, lender fees, such as origination fees, can sometimes be negotiated, or you might find a lender offering a no-closing cost loan, which typically means the lender rolls these costs into a slightly higher interest rate. Additionally, in some markets, it's possible to negotiate with the seller to cover a portion of your closing costs as part of the purchase agreement. Always ask for an itemized list of all closing costs from your lender and attorney, scrutinizing each line item. Transparency is key here. Our seventh golden rule unlocks a powerful but often underestimated strategy, the power of making extra payments. Even small, consistent additional payments towards your principal can dramatically reduce the total interest paid and shorten the loan term. This is due to the magic of amortization. Every extra dollar applied directly to the principal reduces the base amount on which future interest is calculated. For instance, adding just $50 to your monthly payment on a $200,000, 30-year loan at 4% interest could shave years off your mortgage and save you tens of thousands of dollars. It's a passive but profound way to build equity faster. The impact of extra payments is most significant early in the loan term when the interest component of your payment is highest. Think of it like a snowball rolling downhill. The earlier you add snow, the larger it becomes. Another strategy is to make bi-weekly payments. Instead of 12 monthly payments, you make 26 half payments per year, effectively adding one extra full payment annually without feeling a significant pinch each month. This seemingly minor adjustment can shave several years off a 30-year mortgage. Consult your lender to ensure extra payments are applied directly to the principal, not just towards future interest. Our eighth golden rule explores the strategic tool of refinancing. Refinancing means replacing your existing mortgage with a new one, often to secure a lower interest rate, reduce your monthly payment, or change the loan term. This becomes particularly attractive when interest rates have dropped significantly since you originated your original loan. A common guideline is to consider refinancing if you can lower your interest rate by at least 0.75% to 1%. However, refinancing isn't free, it involves a new set of closing costs, which must be weighed against the potential savings. It's a calculation of long-term benefit versus immediate cost. Beyond lower rates, refinancing can serve other purposes. A cash-out refinance allows you to borrow against your home's equity, converting a portion of your home's value into liquid cash. This can be used for home improvements, debt consolidation, or other investments. However, it increases your principal balance and extends your debt. Another reason to refinance is to change your loan term, for example, moving from a 30-year to a 15-year mortgage to pay it off faster, or from a 15-year to a 30-year to lower monthly payments. Each option has significant implications for your long-term financial health and must be evaluated carefully. Our ninth golden rule reiterates a crucial aspect of true affordability: don't forget the TI and PITI, property taxes and homeowners insurance. These are not static figures. Property taxes can and do increase over time as property values rise and local municipal budgets demand more. Similarly, homeowners insurance premiums can climb due to inflation, increased natural disaster risks, or changes in your home's assessed value. Many lenders collect these funds through an escrow account, adding them to your monthly mortgage payment. While convenient, it means your fixed payment isn't truly fixed. It can adjust annually due to these components. An escrow account is essentially a savings account managed by your mortgage servicer, holding funds for property taxes and homeowners insurance. Each month, a portion of your mortgage payment goes into this account. When taxes or insurance bills are due, the servicer pays them on your behalf. While this simplifies budgeting, it also means that when your property taxes or insurance premiums increase, your monthly escrow contribution must also increase, leading to a higher total monthly payment. It's essential to review your annual escrow analysis and understand any adjustments. Being proactive about these potential increases prevents unwelcome surprises. Our 10th and final golden rule, and perhaps the most critical for overall protection: read the fine print. Every single word of your loan documents matters. These legal contracts, often dozens of pages long, contain all the terms and conditions of your mortgage. This includes details about interest rates, payment schedules, late fees, prepayment penalties, default clauses, and what constitutes a breach of contract. Signing without a thorough understanding is akin to signing a blank check. Experts warn that many borrowers only discover onerous terms when a problem arises, by which point it's often too late to negotiate or escape. One specific clause to scrutinize is the prepayment penalty. Some mortgages, though less common now, include penalties if you pay off your loan early, either through extra payments, selling the home, or refinancing. This directly contradicts the strategy of rule number 7. Always confirm with your lender and review documents to ensure your loan does not have such a clause, especially if you plan to pay off your mortgage ahead of schedule or anticipate moving within a few years. Transparency about all fees and conditions is a right, and asserting it can save you significant sums down the line. To fully grasp the mortgage ecosystem, it's beneficial to briefly understand the lender's perspective. Lenders are businesses managing risk. Their primary goal is to assess the likelihood of repayment and price that risk accordingly. Every condition, every clause, every requirement they impose serves this purpose. From credit scores to down payments, from debt-to-income ratios to property appraisals, these metrics are designed to protect their investment. Understanding their motivations can help you anticipate their concerns and present yourself as a lower-risk borrower, potentially leading to better terms. One of the most common misunderstandings is the singular pursuit of the best interest rate. While a low rate is certainly desirable, it's only one piece of the puzzle. A slightly higher rate with lower closing costs, for instance, might be more advantageous if you plan to sell the home within a few years. Conversely, for a long-term hold, paying points upfront for a lower rate can make sense. Financial advisor Sarah Jenkins of Prudent Paths notes, "The best rate is subjective, it's the one that aligns with your financial goals and timeline." This holistic view is paramount. Another widespread misunderstanding lies in the difference between pre-qualification and pre-approval. Pre-qualification is a preliminary estimate of what you might be able to borrow, based on self-reported financial information. It's largely an informal assessment. Pre-approval, on the other hand, is a much more rigorous process. It involves a full review of your credit, income, and assets by a lender, resulting in a conditional commitment to lend a specific amount. Real estate agents and sellers often prefer pre-approved buyers, as it indicates serious intent and a verified capacity to purchase. Don't confuse the two. Pre-approval gives you real leverage. For many, the true aha moment comes with a deep understanding of amortization. Early payments are disproportionately allocated to interest. For example, on a 30-year fixed $300,000 mortgage at 4% interest, after 5 years, you might have paid nearly $60,000 in interest, but only $20,000 off your principal. This front-loading of interest means that making extra principal payments, especially early on, has a much more significant long-term impact on your total interest paid and equity growth. It's a revelation that transforms how you view each monthly payment and the potential for accelerated debt reduction. The journey to homeownership, while complex, becomes navigable with the right information. Each golden rule we've explored, from the supreme importance of your credit score to the often overlooked details in the fine print, serves as a critical beacon. This isn't about memorizing complex formulas, it's about adopting a strategic mindset. It's about empowering yourself to ask the right questions, scrutinize every detail, and confidently make decisions that align with your long-term financial well-being. The market may fluctuate, but your knowledge and preparedness remain constant assets. Let's quickly recap our 10 golden rules. Rule number 1, your credit score is king. Remember, this 3-digit number dictates the very foundation of your mortgage terms. A higher score means lower interest rates, translating to tens of thousands in savings over the loan's lifetime. Prioritize consistent, on-time payments and prudent credit utilization. Before you even dream of open houses, ensure your credit report is spotless and optimized. It's your financial passport to the best possible lending terms and conditions, recognized by every financial institution. Rule number 2, understand your true affordability. Go beyond the principal and interest to factor in taxes, insurance, HOA fees, and potential maintenance. The debt-to-income ratio is your vital personal benchmark. A comfortable mortgage payment should align with your broader financial picture, not just what a lender says you qualify for. Industry analysts consistently show that overextending oneself on a mortgage is a leading cause of financial stress. Be realistic and honest with your budget, considering unexpected expenses and future goals. Rule number 3, navigate the down payment dilemma. While 20% is ideal for avoiding PMI and securing potentially better rates, it's not a universal mandate. Explore options like FHA, VA, or low down payment conventional loans. However, understand the trade-offs, particularly the implications of private mortgage insurance and how to strategically remove it. Every percentage point saved on PMI or interest directly contributes to your equity and long-term financial health. Make an informed choice based on your current savings and future financial projections. Rule number 4, shop around for lenders. Never settle for the first offer. Comparing at least 3 to 5 lenders can yield significant savings over the life of your loan. Focus on the annual percentage rate, APR, to get a true picture of the total cost, not just the interest rate. Utilize the loan estimate document for accurate comparisons, as mandated by consumer protection laws. Your diligence in this step directly impacts your financial well-being, saving you tens of thousands by leveraging market competition. Rule number 5, understand the trade-offs between fixed-rate and adjustable-rate mortgages, ARMs. Fixed rates offer stability and predictability for decades, while ARMs typically start lower but introduce payment uncertainty after an initial period. Your choice should align with your anticipated homeownership timeline and personal risk tolerance. For long-term peace of mind, a fixed rate often prevails. However, for those with a clear short-term exit strategy, an ARM might offer initial savings. There's no single better option, only the one that best suits your individual circumstances. Rule number 6, be prepared for closing costs. These are significant expenses, often 2 to 5% of the loan amount, due at the finalization of the purchase. They encompass various fees, from appraisal to title insurance. Factor these into your budget early, and don't hesitate to negotiate where possible, especially on lender fees or even with the seller for concessions. A surprise at closing can derail even the most meticulously planned home purchase. Knowledge of these costs ensures a smooth transition to homeownership without last-minute financial stress. Rule number 7: harness the power of extra payments. Even small, consistent additional contributions directly to your principal can dramatically reduce the total interest paid and shorten your loan term. This is especially impactful in the early years of your mortgage due to amortization. Strategies like bi-weekly payments effectively add an extra month's payment each year without a noticeable monthly burden. Confirm with your lender that these extra payments are applied correctly to maximize their impact on your equity growth and debt reduction timeline. Rule number 8: understand when and why to refinance. This strategic move can lower your interest rate, reduce monthly payments, or allow you to access home equity through a cash-out refinance. A common trigger is a 0.75 to 1% drop in market rates, but always weigh the new closing costs against potential savings. Refinancing isn't a silver bullet, it's a calculated financial decision that should align with your current and future financial objectives. Periodically reviewing market rates against your existing mortgage is a smart financial habit. Rule number 9: don't forget that PITI includes dynamic components, property taxes, and homeowners insurance. These figures are not fixed and can increase, leading to adjustments in your overall monthly mortgage payment, even on a fixed-rate loan. Understand your escrow account and diligently review annual analyses to anticipate changes. Being blindsided by an increase in escrow can disrupt your carefully planned budget. Proactive understanding and budgeting for these potential increases are crucial for long-term financial stability in homeownership. And finally, rule number 10: read the fine print. Your mortgage documents are legally binding contracts. Scrutinize every clause, especially those pertaining to interest rates, fees, late payment penalties, and crucially, any prepayment penalties. Never sign without full comprehension. If a term is unclear, seek clarification from your lender or consult a legal professional. This due diligence is your ultimate protection against unfavorable conditions or hidden costs. Your signature implies agreement, so ensure you truly agree with every stipulation. The story of the Smiths, facing unforeseen financial strain due to overlooked mortgage details, is a common one. But it doesn't have to be yours. This deep dive into the 10 golden rules of mortgages is designed to arm you with the fundamental understanding needed to avoid such pitfalls. Each rule isn't merely advice, it's a strategically derived principle, built upon the collective experience of millions of homeowners and the expertise of financial professionals. Your journey to homeownership is a significant milestone, and with these rules, you are now equipped to navigate it with confidence and clarity. The ultimate aha moment isn't just understanding each rule individually, but realizing how they interlink and collectively create a robust framework for mortgage decision-making. It's the realization that you have the power to influence your financial future, to turn a complex financial instrument into a tool for wealth building. No longer will the fine print feel like a foreign language, or an interest rate a mystery. You now possess the strategic insights to confidently approach lenders, ask incisive questions, and choose the mortgage that truly serves your unique goals. This knowledge is your greatest asset. Remember, a mortgage is more than just a loan, it's a foundational element of your long-term financial health. The decisions you make today will resonate for decades to come. By applying these 10 golden rules, you move beyond merely buying a house, you actively invest in your future, building equity, managing debt, and securing your financial stability. This investigative look into mortgages reveals that financial literacy isn't just about numbers, it's about empowerment, about taking control of your most significant asset and ensuring it works for you, not against you. We've journeyed through the intricacies of mortgages, dissecting the key principles that govern this pivotal financial instrument. Now, the power is in your hands. Don't let fear or lack of understanding deter you from your homeownership goals. Instead, arm yourself with these 10 golden rules, engage with lenders from a position of strength, and make choices that serve your highest financial interests. If this deep dive has provided you with valuable insights, please like this video, subscribe for more in-depth financial analysis, and share it with anyone embarking on their homeownership journey. Your feedback helps us continue our investigative work.